Hey everyone, today we're going to talk about Dave Ramsey's investing process. Ancient text says, the borrower is the slave to the lender because your most powerful wealth building tool is your income. And when you don't have payments to everyone else, you can save and invest and become wealthy. The average car payment in America is $500. That's amazing. Can you imagine if that $500 was being saved and invested? That one thing would make you wealthy. If you're able to save that $500 for a long period of time, you'd be wealthy. Isn't that amazing? It's very interesting how the entire financial industry is focused on one side of the equation, which is investing. But if you're too much debt and you've not saved enough, the other side of the equation, you cannot invest enough. People don't want to deal with that side of it, the debt, the budget, and the saving. We suggest, and Dave Ramsey suggests, that you invest in funds, mutual funds or exchange-traded funds. Now, when you listen to Dave a lot, he does talk about mutual funds, but in our world, we view the exchange-traded fund as the new version of a mutual fund. And so, using mutual funds or exchange-traded funds, so what that means is we're not investing in individual stocks. We're buying stocks as groups, whether they're in mutual funds or exchange-traded funds.
I personally invest in good growth stock mutual funds. I spread it across 4 types: growth and income, growth, aggressive growth, and international. And I buy mutual funds that have at least a 10-year track record.
And then Dave Ramsey recommends you spread it into 4 groups: growth, growth and income, international, and aggressive growth. These are the 4 buckets that Dave Ramsey recommends. And so that is his recommended portfolio. And he only buys funds that have a 10-year track record.
Index funds, basically an S&P 500 fund, mirrors the market. That basically is the stock market. And so you're going to do exactly what the stock market does, good or bad.
And Dave says it's okay to buy index funds. An index fund, like the S&P 500 index fund, is basically what most people refer to as the market. And it is fine to buy that if that's what you want to buy. But when it comes to the type of the fund, or loaded or no loaded, Dave is totally fine with either type, okay? Basically, a loaded mutual fund is when the advisor is taking a commission on the front to invest for you. Nothing wrong with that. There's other ways to do it. There's fee-based advisors that take a fee for managing your account. But load is okay, according to Dave Ramsey.
Pay a commission, that's fine. Have somebody in your life helping you do the investing. All the data says that you'll continue to invest doing that. But when you're out there by yourself with all your theories, and they some idiot newscaster comes on the evening news predicting the end of the world, what do? You cash out all your mutual funds at exactly the wrong time because you don't have anybody in your corner saying, don't jump, don't jump.
The main point is you want to make sure you know how your advisor is getting paid. One of the key benefits of working with an advisor, whether it's commission-based or fee-based, is you have somebody to talk to, somebody to help you keep your head in the game and keep your head on straight. Somebody in your corner fighting for you that says, don't jump, because their perspective might be different. Their perspective might be looking at other things. That the key is to continually put money in year after year, month after month, in up markets and down markets. You continue to invest, you continue to save. Many people save money, but they're afraid and uncertain about how to save the money or how to invest the money. And so that's where the idea of working with an advisor comes in.
So I'm a multimillionaire and I pay mutual fund fees to my broker. Boom. Just like that. Did you hear that? And you know why? Because I need a broker in my life. I need somebody that's an advisor. I know a lot about mutual funds, but I don't pick my own. I let them pick out 4 or 5. I'm not going through 8,000 mutual funds. I have what's known as a life. I'm going to actually have, pick out 3 or 4 dudes. I'm going to sit down with you. We're going to look at them. I'm going to pick out, that takes me about 30 seconds. And let me tell you how I pick mutual funds. About 80% of the choice on my mutual fund, 85%, is based on its rate of return.
One of the things Dave does not do, he does not manage his own account. He knows a lot about it, but his investing philosophy and his life, he works with an advisor. Dave and his investment looks at the track record of the mutual fund or the fund that he's looking at. And he looks at it for as long as possible. He's looking for time horizons that are as long as possible. He wants to know that people have been doing it for a long time. His analogy to real estate is he's looking to buy real estate that have big oak trees, which means the houses have been there a while. He likes long track records. He likes things that last a long time. The other thing is Dave does not quibble over fees. He does say pay attention to fees, make sure it's not out of bounds, but it's not the most important thing. Although he does compare fees between funds, he wants to make sure they're not out of line. The key is to invest and don't jump in and out of the market. Stay invested. Now, the first thing people ask is about the 4 types of mutual funds Dave recommends: growth, growth and income, international, and aggressive growth. When you're talking about investing, becoming wealthy, there's all kinds of names for mutual funds or exchange traded funds. And they tend to tell you what types of stocks are in the fund. Their names, for example, in the growth and income area will be large cap or blue chip, or when they say large cap, they're talking about large capitalization companies, which are the biggest companies, the largest companies in the market. A growth and income are the large companies. They tend to be kind of boring and they kind of run and they generate growth and income. The volatility for growth and income would be the most calm of the 4 quadrants in the Dave Ramsey model. When things are going up, growth and income is not going to go up as much. But when things are going down, growth and income funds are not going to go down as much. They move slower than the market up and they move slower than the market down. A growth fund is right in the middle. So the second type is growth fund. S&P 500 fund would be considered a growth fund. And so this might include some of the largest companies, but it also includes mid-capitalization companies. A growth fund is going to do about what the market does. Its term is volatility and performance. And so those are the 2 categories. So like I said, the S&P 500 is right in the middle, and it's considered a growth fund or growth index, growth exchange traded fund. The third bucket is aggressive growth, and that's considered the wild child. It's the crazy one. And a lot of times these tend to be small companies because it's kind of wild and growing and very volatile. Volatility is really the ups and downs of the market. These are a lot of times startups. They can be tech companies or biotech companies. Anything that has the potential to really, really grow is aggressive growth. Aggressive growth means it's going to go up faster than the market, but it's also going to go down faster than the market when the market goes down. So you have to be careful with this one because this one will freak you out. But keep you in mind, but it's only one piece of the overall puzzle. The fourth bucket is called international stocks. These are stocks outside of the US. These can also include global funds. And so global funds include stocks that are international as well as in the US. And so global is also in this category. So those are the 4 types. So you spread your investing over those 4 types. That is the Dave Ramsey investing philosophy. Growth, growth and income, international and aggressive growth. Those are the 4 areas of his portfolio. So it's very simple. The key thing is to do it, to get involved and participate. Everybody talks and talks and talks about investing. The difference between those that win and those that don't are the people that do it. You got to get involved. If you talk to millionaires, it's never about the home run. It's never about the fund with the lowest fees. It's about the fact that they did it over a long period of time. They saved, they were on a budget, and they put money they saved and put it into investments. Millionaires never talk about the home run or the tip they got at the golf course. More often than not, it has to do with investing over the long term. If you talk to millionaires, you rarely hear them talk about the incredible stock or the incredible mutual fund they got. It really has to do with a long-term perspective. Now, there are stories about the tip or the stock, the Tesla stock or the Facebook stock, but for the majority of people, It's about investing consistently over the long term. It's about slow and steady. As they say, the tortoise wins the race, in the story of the tortoise and the hare. If you've been to Financial Peace University, you know Dave uses that as an analogy. So investing is the way. Slow and steady wins the race. So 4 buckets: growth, growth in income, international, and aggressive growth. Don't chase the market. Don't chase the returns. Stay focused on those buckets. And that is Dave Ramsey's investment strategy. Okay. So the other thing that he says is to invest in areas you understand. It's what Dave Ramsey says. It's what Warren Buffett says. Invest in things you understand. If it's too complicated, you don't understand it, don't invest. A lot of times when people get ripped off is when they invest in things they don't understand. And so important to understand it. So if you're going to have money, you got to understand it to the point where you can save and get it invested. All right. So you don't have to have a master's degree. You don't have to be an expert, but you do have to know enough to have an advisor that can educate, talk to you. And so find an advisor that's not a salesperson, that has the heart of a teacher, somebody that will help you make better decisions with your investments. They may make a commission. They may get paid to help you. They may receive a fee for managing your account. That's totally fine. But if they have the heart of the teacher, that's what's most important, not the heart of a salesperson. And so they sell not by twisting your arm, but by helping you understand what you're investing in and allowing you to choose to do it. So don't put money in things you don't understand. Hire an investment professional that has the heart of a teacher. And the big deal is to pick investments, get your investing going, and do it every month, do it every week. And if you need some help, find an advisor that you like and work with them to make this happen. So a lot of information today. Today we talked about Dave Ramsey's investing process. A big deal. A lot of people follow Dave on the radio. We are SmartVestor Pros and happy to help. Please subscribe to this channel. Hit the subscribe button, hit the bell to subscribe. And we look forward to talking to you again next time. Thanks so much for stopping by. Bye for now.